Canadian equities had a strong run in 2025, but are the conditions right for that run to continue this year? Joining us now to discuss, Michael O'Brien, Managing Director and Co-Head of Canadian Equity Portfolio Management with TD Asset Management. Welcome back to the program.
Thank you very much. Is it too late to say Happy New Year?
I think we're allowed to the end of the week. I think we got till the end of this week. And
well,
then,
Happy New Year.
So we'll say Happy New Year to each other. We had many discussions through 2025 about the strength of the TSX, the outperformance of the TSX against the American markets. What are we thinking about this year? What's the setup like?
Yeah, well, I mean, welcome to the new year. It's a little bit different setup, entering 2026 versus last year, in that the bar is it's been set a bit higher. Obviously, we had an extremely strong year last year. Part of that was fueled by earnings growth, but also there was definitely some upward, valuation uplift that happened through the year where, a lot of these key sectors tacked on some appreciation there. So I would say the bar is set higher, but the backdrop is actually pretty encouraging. And the reason I say that is, if you look at what's really supportive of equities coming into the year, is you've got that nice combination of the economy sort of buckled a little bit last year, but it held in. It got through the worst, and I think there's a feeling that the worst of us hopefully is behind. So you've got a little bit of a bit more momentum or a little bit more confidence in the economy right now, and supporting that is you have both monetary policy and fiscal policy have really been doing their part or will do their part as we go through 2026. So that's the basis for the optimism. We've got a Bank of Canada that's cut rates from 5% to 2.25% over the last year and a half. That's going to definitely help. So the central bank's done its part. And the federal government, obviously a big turnabout there. We're going to see a much more stimulus-heavy budget than we've seen in a while. And going to the things that really matter. So infrastructure spending, you're going to see a big boost in defense spending. You've seen some tax changes. So, that fiscal and monetary support, I think really sets up the market well. But like I say, the bar is higher this year just because of last year's success. So, we need those good things to play out.
Let's talk about where that bar has been set for some of these subsectors of the TSX. Obviously, mining played a big role last year with the price of gold, the price of silver. I have my heat map open on the screen showing a one-year performance across the miners, and I'm looking at gains of 190%, 50%, 200%. It was a big year for gold and for the miners. What do we think about the mining outlook this year?
Yeah, well, I mean, just to emphasize that was not just a good year, it was an outstanding year for them, and driven by the golds. The gold companies, gold and silver, are now something like 14 or 15% of the TSX composite. Big number. Gold last year went from, I think, $2,600 an ounce at the beginning of the year. It exited at $4,300 an ounce. So an extraordinary year for gold bullion. And like you say, the precious metals miners were all up, 100% plus. So that's a tough act to follow. I would not encourage our listeners to
think they can do it again.
To expect we're going to get another 100% return in the materials space. That said, in a world that seems to be getting turned upside down every day, where a lot of things we just can't imagine seem to be happening in routine fashion. Gold has done exactly what it's supposed to do, which is it's a hedge against what you ask, pretty much everything. Geopolitical uncertainty, potential, worries about central bank independence, this, that, and the other thing. It's a hedge in a confusing world, and this world is nothing if not confusing at the moment. So, so all of that to say, while I can't imagine gold's going to double again this year, I don't see a real strong reason for why it's going down either. So, I'm relatively constructive. Any mining company that can't make money with these commodity prices, it's got to go back and take a look in the mirror. So, I think we should expect a little more modest returns, but I think the general direction of travel is positive.
Right, let's work our way through the big three as we hit on the miners. The financials as well, when we think about the drama of last April and the tariffs and our continued worries about our relationship with our largest trading partner. I'm looking at the numbers for the financials over the past year and the banks and the life cos. These are some pretty big numbers too for the space.
Absolutely. I mean, I think the total return for the financials sector was 33% or 35% last year. And it was the banks that really took the lead last year after, a couple of years where the insurers had outperformed the banks, which is a little unusual historically. The banks really, they really reasserted their leadership last year. I think, last year's story was really about the worst fears not happening, not occurring. And so what you saw was people who, especially after some of the early tariff fears, were like, oh boy, where are the bank loan books going? As we exited the year, they're actually in pretty good shape. Earnings growth across the major banks were, mid-teens, very solid performance. So they're exiting on a high note, similar to, the materials story, like the bar has been raised. And so the outlook for the banks looks pretty positive coming into 2026, but valuations are towards the high end of their range. So, obviously investors like us are expecting more progress. From what I can see today, base case is that they deliver on that. But if they don't, then there's an issue there because the valuations are expecting good things.
Now, energy is a very interesting space considering last year the price of oil wasn't so great, but a lot of our Canadian energy names hung in there. We still have an oil price forecast that isn't so great. Can the energy stocks do that again this year?
Yeah, well, I mean, that's a trick. And I think the short answer is probably no. They're going to need a little bit of help from the commodity. But to your point, if we had sat here a year ago and you had told me, okay, Mike, I'm going to tell you that oil prices are going to fall 20% over the course of 2020. And that's roughly what they did. I think they
2025.
Or 2025, sorry, yes.
Don't take me all the way back there. I'm glad we're past all that stuff.
Yeah, that was a bad year. But, at the beginning of the year, I think crude oil started the year at low 70s, like $72 a barrel, exited around 57. What are we today, like 55, 56? If you had told me that oil prices were going to fall 20% and then said, okay, what do you think is going to happen to the stocks? I would have said they get smoked. But they didn't. Like you say, I think, whether you look at the pipelines, whether you look at the producers, they generated, solid, mid-teens, 20-some% returns. Pretty outstanding. Why did that happen? I think, one is just that these are better, more resilient businesses than they used to be, which means they can hold up better under a falling oil price than they would have, say, a decade ago when they had more debt on the balance sheet, for example. But the other, obviously, really big tailwind that they had last year was this 180-degree turn out of the federal government in Ottawa, where energy investors and energy companies had spent a decade dealing with a government that was essentially trying to impede them from developing the resource, keep it in the ground, to a new government that is guns a-blazing, let's build, let's get stuff going, that sees energy as part of the solution long-term for the Canadian economy as opposed to a problem that needs to be stymied. And so I think that's a one-time uplift in sentiment that definitely helped these stocks hold in better than they would have otherwise. As I look at 2026, I think a lot of this depends on where oil prices go. I'm going to be honest with you, I think the oil market looks pretty sloppy today. I think there's probably more oil in the market than needs to be there. So I would have muted expectations. If oil prices stay in this range, I don't think we should expect fantastic results from the stocks. But, some of the pipeline companies, nice and steady. Like I said, the big, strong, leading companies are very resilient. They're going to continue to pay solid dividends. They're going to continue to buy back a bit of stock. So I don't think it's going to be a hugely negative year for them, but they're going to have a tougher road for them to hoe than some of the other sectors in the market.